Oh, that's real good.
Hello everyone, and welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. Eliminate this horrible urge to participate in profit making that appears at the end of each significant bubble. Do whatever it takes to get rid of this dread of losing out. It is challenging to resist. It has completed all the everyday actions of a super bubble and could begin to deflate at any time. It requires a protracted bull market, which we enjoyed for 11 years, the most prolonged period ever. It takes a lot of crazy behavior, and we've had some of the most incredible insane conduct ever. After a bubble, it needs to speed up. It achieved that at a rate around 3 times the bull market's typical rate. The Nasdaq increased more than 3 times as fast as average after COVID. Last but not least, a characteristic of the super bubble is that, in the end, the speculative stocks begin to separate, and even when the market has an uptick, they begin to decline. That started at the start of last year. The worst of them all, the super-duper SPACs, began to decline. Then they began to plummet and fell in one by one. Approximately 40% of all Nasdaq equities are currently down more than 50% as of this writing. In late December, the S&P reached a record high. Nothing in life is inevitable, but that is just the beginning of the blast. When the SPACs usually increase quite a bit more than the market decreases as the market increases, many of the most speculative equities for 2020 were already declining when the S&P rose by 25% last year. The global real estate market is highly competitive. The bond market shows that bonds are costly and that interest rates are meager. But rather than being about the stock market, this is primarily an American issue. The rest of the world is simply too expensive. In the United States, it's frequently pricey and generally not very harmful. However, we have severe overpricing. We're in a somewhat dangerous equities bubble. Therefore, there is a good likelihood that Japan, the UK, and Australia are among the nations with comparatively low prices. If they descend in sympathy, they will do much more slowly and most likely recover faster. The Nasdaq and SPACs are the leaders of this US bubble, which is uncannily comparable to the tech bubble of 2000. The S&P continued to rise as the SPACs underperformed the entire year of 2000. The S&P may increase to a new high, but not SPACs. Therefore, I believe that the game has begun and will proceed in the manner of 2000. In the past, the stock market has detested inflation. Price-earnings ratios are destroyed. This time, it didn't. Inflation began in June of last year, roared through the ceiling, and the P/E ratios kept increasing. That had never occurred before. Price-earnings ratios, or the market's price level, are determined by 2 criteria in our model, which date back to 1925. Profit margins and inflation are 2 of them. They have been quite effective. For instance, in 2000, the top of the market had meager inflation and profit margins that set new records worldwide. Despite having record high profit margins today, inflation is still very high. If the market had followed the conventional war strategy, it should have fallen in the middle of last year. It didn't. The market is signaling that it ignores inflation. In the end, it takes the Fed's word for it. If the market picks up on phrases like temporary, fleeting, and so on, it will ruthlessly lower the price-earnings ratios. In the end, the Fed prefers not to offend the administration. In politics, inflation is debt. The ordinary person observes, quantifies, and exaggerates it. But even without hyperbole, it's uncomfortable and difficult politically for the voting pattern. As a result, the administration is trying everything to reduce inflation. As a result, It will subtly rely on the Fed to take action. In my opinion, they will undoubtedly move to the firmer end of the range. They will make every effort to prevent inflation from setting in. I'm also confident that will be challenging given how scarce labor is right now and how U.S. wage rates will rise over the coming few months. Controlling inflation becomes exceptionally challenging as a result. It will be difficult, and the Fed will need to boost interest rates significantly. If you must own American stocks, make sure they are of the highest caliber and financially sound, because this might always become a financial crisis, as they frequently do. Non-U.S. stocks and quite a few other nations are generally not that awful. If the United States leaves and commodities are expensive, emerging markets could face some overhang issues. At best, this would be a mixed blessing for them. However, they were inexpensive, and in the end, cheapness typically takes precedence over everything else. Therefore, investing heavily in developing markets, some of the less expensive established nations, would be far better than doing the same with American stocks. It appears to be coming to an end. I'm attempting to compose a paper about the end of the Golden Age. For the first 20 years of the 21st century, everything was different. Profit margins were, on average, 30% to 35% greater, and the P/E was, on average, 50% to 60% higher than it had been for the previous 50 to 60 years. Everything seemed to work out. Companies gained significant political sway. Capital gains taxes were eliminated, and corporations took over most regulatory agencies. They also went through a golden period, with recorded the highest profits. Every industry is becoming more concentrated, and the FAANGs and other big businesses have the potential to become near monopolies. I've always believed that you get what you pay for. Thus, I don't believe in price book, especially given how drastically distorted the book has become over the past 20 years as an accounting item. In the 1990s and 1970s, it served as a reasonably reliable proxy, but not anymore. I've always believed that the most excellent method to define value is a dividend discount model, which projects earnings into the future and discounts them back by company quality, with high-quality companies having a lower discount rate than poor companies. And what we almost 40 years ago as we investigated the regression rate by type of company. On a company-specific basis, we attempted to ascertain what regression rate they were likely to experience if they usually acted, given their unique traits. As a result, Microsoft was included in our value portfolio. We continued to use it from the 1990s until June 1999. We began to carve it out. We had 12 monthly portions, and by June 2000, we were done with it. Using those models, you can see that developing markets are affordable. They are roughly as cheap as they have been in one or two earlier instances. You are aware that they are pretty good. And among that group, the absolute price appears to be appealing. Emerging markets are very varied. 28 nations are included in the index, with China accounting for 40%. The largest economy in the world, China, is significantly more significant than the United States and is expanding much more quickly. They've already widened the GDP deficit by 10% this year alone. Currently, we have a -4% to +6% GDP gap, and they are working hard to close it. According to the IMF, they will be responsible for nearly a third of global growth. Then there is India, expanding faster than China before the current epidemic, is poised to create a massive economy and is interestingly investing in intellectual property, consulting, and deploying actual brain power. Then there are intriguing risky pots. It is the future in a world where the developed world's growth rate has been steadily declining for the past 40 years. Keep yourself clear of trouble. Make sure you don't invest in expensive markets or equities. Instead, focus on the value and affordability of what you obtain. Look around for the cheapest countries and the cheapest equities in those countries. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, one penny lesson a day keeps being penniless away. Cheers.